Hello, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. You are tuned in to On Trend, the show designed to keep you on the right side of the trend. So today we're going to show you what the 200-day moving average has to do with volatility. Then we're going to show you Charles Dow's interpretation on dealing with depth and duration. We'll show you how to scan for stocks above and below the 200-day moving average. And we'll also show you the potential game changer for technology. And finally, we'll close out with some commodities that are in uptrends. Volatility, aka risk, increases when below the 200-day. So there was a paper written in 2016 by Charlie Bilello and Michael Gayed, and it is called Leverage for the Long Run. And if you just Google leverage for the long run, you'll get a list of results. The first one will probably be a link to that paper. And then below that, you can see a link to their website, which is Pension Partners. And you can go to that website to read their blog. And it's a great blog, and I'd recommend you check it out. Here is the post that Charlie wrote after the paper came out, Leverage for the Long Run. And then you can see here is the link for the paper if you want to read it, and I would recommend you read it. Now, what is it about? Well, I'm going to take a look at the paper and highlight some of the main points that I think we need to keep in mind, especially now that the S&P 500 is below its 200-day moving average. So this paper did win the Charles Dow Award from the CMT Association in 2016. And I've highlighted a couple of sentences and paragraphs here that I'd like to go over. And basically in the abstract, it says the conditions under which higher returns would be achieved from using leverage then are low volatility environments that are more likely to experience consecutive positive returns, which is what we basically had in 2017, 2013. We find that moving averages are an effective way to identify such environments in a systematic fashion, no guesswork. When the broad U.S. equity market is above the moving average, stocks tend to exhibit lower than average volatility going forward. All right, highly daily average performance and longer streaks of positive returns. It's a tendency, market's trend. When below its moving average, the opposite tends to be true as volatility rises, average daily returns are lower, and streaks in positive returns become less frequent. So in other words, it's a heck of a lot harder to make money when the S&P 500 is below its 200-day moving average. Now moving further down into the paper, it says the trend is your downside protection friend. And this is kind of like the chart I showed in the weekly market review and outlook. All right. When the salmon are running, we need to feast and we need to fatten up. All right. When the salmon are not running, I used a bear as an example, we need to hibernate, rest up, and have enough profits from when the times were good to survive when the times are bad. All right. So the trend is your downside protection friend. It says using a simple 200-day moving average in these bull market periods indicates that such a strategy underperforms a buy and hold approach in strong periods of trending markets, despite the indicator's purported use as a trend indicator. So it's not like you're going to outperform in bull markets unless, of course, you apply some leverage. So they did some testing here, and they tested some bull market time periods, and they compared the S&P 500 performance with the 200-day as the timing mechanism. And you can see buy and hold did not outperform the 200-day in any of these cases. All right, but that's why you need leverage in order to outperform buy and hold. But as Jeremy Siegel notes in Stocks for the Long Term, the major gain of the moving average timing strategy is reduction in risk. And you can see it on the table below. In the bear markets, if you use that 200-day moving average to get out, you can see your drawdowns would have been a lot less. 86% versus 16%. And the most recent one, 55% versus 10% for the drawdown. So this chart shows the S&P 500 with the 200-day moving average in red and then the VIX below to kind of represent volatility. Now we did kind of go through a change in the volatility regime because you can see it was fairly high in 99 and at the beginning of 2000. But then when we moved below the 200-day moving average there at the end of 2000, you can see that volatility moved higher. Your risk was much higher and it would have been a lot safer to be in treasury bills or on the sidelines. All right, then in 2003 and 4, we had low volatility into 2007. And this is when you wanted to lever up and fatten up while the trend was up. And we had an increase in volatility, of course, in 2008, 2009 with that huge spike. And then we had some choppy trading in the first few years after the 2008, 2009 financial crisis, which is pretty normal. I mean, there are a lot of traders, investors that were bitten and bitten hard, hit hard, and they were reluctant to go in. But then you can see we had that volatility go really low when we had the nice uptrend there. And that's when you really need to fatten up, 2013 and 14, to make those outsized gains, to buy those momentum names so you can survive when we have these drawdowns like in 2015, 2016, and possibly one now because we're below the 200-day moving average and the VIX is above 20. So volatility is higher and it's going to be much harder to make money according to what has happened in the past. Now I've got 5 major indexes and the 200-day, and then below I've got the 50, 200, 0 PPO, which tells you the difference between the 50-day moving average and the 200-day moving average. And so we can see here, there's the S&P 500 moving below its 200-day moving average for the first time on a closing basis since this early April period. And I dare say it's closed twice below the 200-day moving average in the last 3 days, and it did not do that in April. So this decline appears to be a little bit more behind it than the decline we had in February or April. And then if we go down the line, we can see that the S&P 500 equal weight index is even weaker. It's much further below its 200-day moving average, and it is broken down. So I'd view that as a negative. You know, if you want to put a weekly chart on there or monthly and say the mother of all double tops is forming, you're welcome to do that. But I think it's a moot point because I think the evidence has turned bearish. So why you need to add something else to that? You know, it's already bearish. So here's the NASDAQ 100, and it's holding up a little better, but as I'm going to get on later on, I think we've had a game-changing event out there in technology land, and I'll explain that. So I think technology is going to be under fire for quite a while. And the NASDAQ 100 is above its 200-day moving average, but I would expect it to break and move lower because it's not going to buck the broader market. And then things get worse when we go down to mid caps. You can see the mid cap index broke down there last week and is well below the 200-day. It was much further. It held the 200-day pretty much in February, March, April, May, and now it broke it. So that tells you there's something different happening right now than in February, March, April, May. And then we look at small caps, the same thing. All right. Held the 200-day moving average there in February, March, April, and clearly broke it now. So we need to move to bear market rules and act like it's a bear market. We can't pretend because I think we are in a bear market environment. Applying Dow Theory to the current reversal in the stock market. Now, in Friday's weekly market review and outlook, which is behind the paywall, I showed the 9 breadth indicators that I've been tracking for years. And they were bullish, net bullish. The majority of the 9 were net bullish in March 2016, and they stayed bullish until Friday. And Friday now we have a majority that are bearish, and I'm abiding by that bearish signal because I said, what would it take for me to turn bearish on the stock market and adjust my positions. Well, that's what I said it would take, and that has happened, and so I need to make the adjustments. You have to listen to your signals. They're going to be whipsaws, they're going to be bad signals, but hopefully the good signals will pay for the bad signals in the end. Now, as far as estimating the length and the duration of a potential decline, I have no idea, just like Charles Dow would say. And I'd recommend it's a good time to go brush up on your Dow Theory, and you can do that in the chart school. If you go up to the top of any web page and you search for Dow Theory, you'll be taken to the list of articles that have Dow Theory. There are no support articles, but there you see a link for Chart School, and you click on Chart School, and there at the top is a Dow Theory article written by yours truly. And I want to highlight three things. All right. The first thing is about the primary trend, and it's a little bit further down in the article. Excuse me for the scroll. But here is the primary trend that we're talking about. And basically, as far as the length and the duration of the trend were largely indeterminable. All right, so what you have to do is identify that change in trend and adhere to it until you get a signal that tells you it has reversed. All right, so you cannot estimate the length or duration of a primary downtrend, which I think we have started. Now, secondary movements are different. All right, they run counter to the primary trend. So the primary trend is down, and Charles Dow estimated that primary moves or secondary moves will retrace 1 to 2/3 of the primary move. So those we have a chance of estimating. All right, so if we have a big move down, then we would expect a counter trend bounce to be 1/3 to 2/3. All right. Now the third thing would be what they would call the daily fluctuations, and that was viewed as noise. And that's probably what we're going through now. We're getting a lot of daily fluctuations. But I do believe the weakness that we saw here in October was enough to turn bearish on the broader market. So here is SPY. And, truth be told, I could make a case that we're still in an uptrend for SPY. All right, because, we had this breakout and the move to new highs, and we had a sharp decline, but we're still, above the last lows. But then, that's why I use breadth indicators and other indicators. But then the breadth indicators turn, you see the breakdown in equal weights and small caps, and I think there's just too much bearish evidence to ignore. You have to go with a weight of the evidence approach, I think, here. And so I think the S&P 500 is bearish. Am I going to mark support here? No. And I'll tell you why. Because if I am bearish and I think prices are moving lower, or I think the chances are prices move lower, then support really doesn't matter. It's expected to break. All right. So I wouldn't hold out and say, well, okay, if it breaks 250, then I'm going to exit. Well, I've already made up my mind that I would change my stance when the breadth indicators change, and they have changed. And so I need to make the adjustments now. I'm not going to wait for the 50-day to cross below the 200-day, or I'm not going to wait for a break below 250. I'm just going to adhere to this bearish signal until it is proven bullish again. And I have no idea when that will happen and how long this bear market or bear run, I don't know if it's a bear market, how long it will last. It'll last until it lasts. Scan code for stocks above and below the 200-day moving average. So as longtime readers know, I do believe in a weight of the evidence approach when it comes to assessing the broader market environment. And part of that weight of the evidence approach can be looking at the number of stocks that are above or below the 200-day moving average. So I'm here on the technical scan workbench, and I just want to show you a really simple way to do that so you can kind of get an immediate assessment of the broader market. So up at the top, I've got group is SP 500. You can see it's enclosed with brackets. And then the two forward slashes mean I could ignore everything to the right there. Now you can also use SP 400 for the S&P 400 mid cap, SP 600 for the S&P 600 small cap, or NASDAQ 100, of course, for the NASDAQ 100. So that's my first line. Group is S&P 500, and I want the close to be above the 200-day moving average. And then I'm ignoring these two lines for now because I've got the two forward slashes in front there. That means everything to the right is ignored. And I'm ignoring this rank by here as well. And I want to rank by market cap. All right, so I get the biggest at the top. And if you go down here, you can see on your scan building blocks, you've got ticker properties. And there is market cap, and you can just click that and add it if you want to add that. So that's a real easy way to do it. So I'm going to click check my syntax to make sure everything is okay. And I get the green light there, the syntax is all right. And I'm going to click run scan. And so that is going to refresh, and I'm going to get all the results. Now I don't need all of the columns, so I'm going to go ahead and remove scooter and universe and close and volume. And so that'll narrow it down. I don't need exchange either. And then we'll see which stocks are currently above the 200-day moving average. And perhaps more importantly, the total number there. So you can see 227 of 500 stocks are above the 200-day moving average. So 250 would be half. So that means less than half are above the 200-day moving average. That is a net negative for the market. All right. Now look at some of the leaders that are above the 200-day moving average. Apple is above, and there you can see it's got the biggest market cap. Amazon, Microsoft, Berkshire, and then we get into Johnson & Johnson, more defensive, ExxonMobil, Visa is still above, Walmart, Pfizer, and United Health. All right, so you can see three healthcare names there, and that would explain why the healthcare sector is holding up so well. Now I'm just going to go back and I'm going to change this up a little bit. I'm showing the other scan code in case you just want to use it later on. But if we say go to the S&P 600 small cap instead and run this scan, all right, we're going to get some different results, I believe. And I'm more interested in the top number. So there's 600 stocks in the S&P small cap index, and 230 are above the 200-day moving average. So there were 227 stocks in the S&P 500. We added 100 more stocks to our index, and we only have 3 more. So that's like 38% of the S&P small cap 600 are above the 200-day. So there's a lot of weakness in that index, and that's another reason to be negative on the broader market. Now, instead of a scan, we can also do something visual with the sector SPDRs. If we want to know how many are above or below a particular moving average, we can use the PPO to find that out. So I've created a chart list here, and you can see I've got the 11 sector SPDRs and SPY. And so I am going to view that as a candle glance chart, and that's going to give me all of them on one page. You can get up to 30 on one page. This is my custom style, but I'm going to go ahead and change this to 1 year, and then I'm going to add an indicator. All right, and I'm going to add the PPO, the percentage price oscillator. And for the short moving average, I'm going to put 1. For the long, I'm going to put 200. And for the signal line, which I don't really care about, I'll just put 1. And I'm going to click go. And that is going to show all of these charts with the PPO 1, 200, 1. And so you can see when that PPO is positive, which it just barely is for XLY here, that the price is above the 200-day EMA, but barely here. Now, what I'm also do is I'm going to sort descending. So I want to put the highest numbers at the top. All right, so now we can see which sectors are leading by way of which sectors are the furthest above their 200-day EMA as measured by the PPO. So you can see XLV is like 4.5% above its 200-day EMA because the PPO is right there near 5. U for utilities is the second strongest, and it's kind of got a support zone there around 51. So you close below that level, you'd have to reassess. But these are the two that are holding up the best right now. And then we can see XLY is right at its 200-day EMA because that PPO is right near zero. Same with XLK, all right? That PPO is right near zero, and the 200-day EMA is not shown here. This is the 20-day and the 50-day, but we can see that this one is pretty much at a moment of truth. SPY is just above its 200-day EMA, so SPY includes dividends. The S&P 500 does not, so that's why there's going to be a slight difference there. XLP is right near its 200-day moving average, so it's at a moment of truth. So right there, we can see a number of sectors are getting pretty close to a moment of truth. And so if we get any more broad market weakness, we're going to see XLY and XLK move below their 200-day moving averages probably. We look at XLE, it is just below its 200-day moving average. So the cup is half empty here for XLE. You see XLI is below its 200-day EMA, so the cup is half full here as well. And then it gets a little bit worse. XLC is well below its 200-day EMA. We've done a little historical data. We've added that to our Sharp Charts workbench based on the Communication Services Index from S&P. We applied that and backfilled that XLC data with that. We have XLRE below its 200-day. We have XLF, one of the worst performing sectors, the furthest below its 200-day. And of course, the weakest sector is materials. But you can see here, there's not a lot to be positive here because we have basically 1, 2, 3, 4, 5, 6 sectors below the 200-day moving average. And it wouldn't take much to put a few more below as well. A possible game changer for technology and especially semiconductors. So when it comes to fundamental reasons, I'm kind of the opinion that it doesn't matter until it does. All right. There are lots of fundamental issues out there that you could blame for the current decline that we've had. I mean, it's been a pretty drastic decline, 2950 to 2750 in the S&P 500. But was there a catalyst? What kind of was the straw that broke the bull's back here? And so I went back and I studied some things. I did some reading, and I came to the conclusion that I think there was a catalyst, and I think it is going to affect the technology sector for possibly some time to come. And I'll get to that here in a second here, but here's treasury yields. Okay, that's a negative. You know, we went from 2.1% to 3.2%. We've been above 3% for a few times over the last 6 months. So that's clearly not a positive, but Treasury yield's been rising for a long time, and they didn't derail the bull market all of a sudden. So I don't think it's Treasury yields, but I don't think that was a positive influence. Another thing is the price of oil. All right. Oil has been moving up for over a year. It's gone from 42 to 72, and it's in a clear uptrend. So, that means higher interest rates, which is a cost, higher fuel cost, which is a cost, obviously. So that could be weighing on the market. That's definitely not a positive for some companies. All right. And then I looked at the semiconductor index, and this is the one that I keep coming back to because, look at that. It had a lower high from March to June, another lower high from June to September. I probably should have cued on this a little bit more, and then a clear breakdown there, and it's below its 200-day. So something really hit the semiconductor industry hard. All right, China has been weighing on the markets possibly. We got the trade wars and all that. The Shanghai Composite has been moving down all year and hitting 52-week lows. So that's clearly not a positive for the market. Then we look elsewhere in Europe, and we have the DAX, hitting new lows here in October and moving down most of the year. We have the Italian index taking a big hit from May to October and hitting a new low. And the Spanish index has been going down all year. But the thing is, when it comes to the U.S., I like to look at what affects the U.S. And so when I was doing my reading, I came across this article from Bloomberg. And I did read it at the time, but I didn't read through the article, and I didn't, realize how big this could be. The big hack, how China used a tiny chip to infiltrate infiltrate U.S. companies. And I'd recommend you take a read of that article because I think it could be a game changer and it could be bullish for the long run, but I think it's going to shake things up for the short and medium run because whatever 70, 80% of computer hardware, cell phone hardware, all of that is made in China. And so all of a sudden, if there is a lack of trust, then that means that manufacturing is going to move back to the U.S. or somewhere else where the trust issue is higher, and that's going to involve higher costs. But in the long run, it could be a bullish development. But I think that is why semiconductors have been underperforming for so long because this issue has been out there. And it also goes back to the premise that I make that we can't like go and pick the issue that's going to affect the market because usually it's an issue that you don't even know about. And this one didn't come to light until October 4th, as far as I'm concerned. Maybe it was out there before, but October 4th was the day that this article came out, and technology has been hit really hard since then. So what do the charts say? Well, here is the semiconductor index, SOXX, and there you can see the top holdings, and it's weighted towards the large caps, Broadcom, Qualcomm, Intel, Texas Instruments, NVIDIA, and so forth. But you know, while the S&P 500 is making new highs here, we had a lower high in the SOXX, and then we have this breakdown. We've broken below the summer lows, and we've broken below the 40-week moving average. And then here I've got the PPO 526.0 on the weekly basis. It turned negative last week, so that's a breakdown, a trend change, the first time since February 2016 back there. This is basically the difference between the 5-week EMA and the 26-week EMA. It's kind of I would call it a medium-term trend indication, because if you use 1040, that's getting a little bit longer term than I like. I wanted to shorten it a little bit. And you can see RSI, this is how strong the selling pressure was. It pushed RSI to its lowest level, actually even lower than that low in January. When you have that kind of strong selling pressure, it's a suggestion that something out there is not quite right. And that's what might be happening here with semiconductors. And that could weigh on the technology sector for a while. And if we look at XSD, which is the broader base semiconductor ETF, there you can see the holdings on the left are more equally weighted. All right. We had a breakdown here with this move below the summer lows, and the PPO also turned negative last week, and RSI hit its lowest level in over 3 years. So that's how strong the selling pressure is. So we have a clear breakdown in semiconductors, and I think this could weigh on the rest of the technology sector. Now let's turn away from stocks and look at gold, oil, and palladium. All right, here is palladium, the ETF in the upper window, and you can see it pulled back into the summer and then broke out with that big move up in August and September, and that breakout is holding. So it is one of the stronger groups out there. Gold attracted some buying interest. I featured gold last Tuesday in On Trend as well as in Market Watchers with the Bollinger Band squeeze. We got the head fake here in late September and then the big breakout. And if you look at a weekly chart, you can see that gold's gone nowhere for over 2 years. It's been in that flat range, but it looks like it is turning up and could be ready to challenge resistance from the upper end of that range. Copper is still in a downtrend, so nothing much going here. It surged and then consolidated. Unless it can get a breakout here, I would be bearish on copper. And then oil is at a potential support zone. You can see there broken resistance turning into support as it retraces 50% of that prior advance. All right, so that concludes this edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend. Have a great day.